Welcome to Book to Blueprint, where powerful books become practical blueprints for real life. You do not need more information, you need execution. This is Book to Blueprint. Today, we're cracking open Christopher Leonard's The Lords of Easy Money. And let me tell you, this is not just some dry book about finance. It's really the secret history of a gigantic economic experiment that has completely reshaped our world over the last decade. And it all revolves around one man, one guy who saw the danger coming and tried to sound the alarm. So picture this. It's November 3rd, 2010. Inside the huge marble halls of the Federal Reserve, a man is getting ready to cast a vote. A vote he knows is doomed to fail. A vote that's going to pit him against the most powerful financial force on the planet and pretty much define his entire career. And that man's name was Thomas Hoenig. At 64 years old, he was the president of the Federal Reserve Bank of Kansas City, and honestly, he was the absolute last person he'd ever expect to see leading a rebellion. Yeah, and this is what makes his story so fascinating. See, this wasn't some firebrand outsider. Hoenig was the ultimate insider. He'd been an artilleryman in Vietnam, got his PhD in economics, and spent his entire career at the Fed, working his way up from a bank rule enforcer to a president. He was a by-the-book guy, a true institutionalist. And that's what makes his stand so extraordinary. For the entire year of 2010, at every single meeting of the Fed's powerful policymaking committee, Hoenig's vote was the same, a single, lonely no. He was consistently outvoted, sometimes 11-1. So that brings us to the big question. What on earth was this experiment that he was so desperate to stop? Well, to understand his no, we have to rewind the clock 2 years, back to the event that nearly broke the entire world, the 2008 financial crisis. You remember it. When Lehman Brothers collapsed, it wasn't just another bank going under. It was like the Jenga block that brought the whole tower down. The entire global financial system just froze. We were staring down the barrel of another Great Depression. So, in response, the Federal Reserve, the one institution that can literally create US dollars out of thin air, unleashed its superpower on a scale nobody had ever seen before. To give you a sense of just how massive this was, think about it like this. For almost 100 years, the Fed's money supply chart was a slow, steady, gradual incline. Then, after 2008, bam, it's a vertical line, a reverse lightning bolt shooting straight up. That spike, that is the experiment Hoenig was so afraid of. So, the Fed's emergency plan really stood on two legs. Two radical new policies that, to be fair, Hoenig had supported in the heat of the moment, but now he believed they were turning into a dangerous, long-term addiction for the economy. The first light of the plan was something called quantitative easing, or QE. Now, it sounds super complicated, but the core idea was pretty simple. The Fed was going to create trillions of new dollars and use them to buy things like treasury bonds directly from the biggest banks. The hope was that this would flood the banking system with cash, pushing interest rates down and encouraging them to lend that money out. In the process itself, it's almost unbelievably simple. A trader at the New York Fed just picks up the phone, calls a big bank like JP Morgan and says, hey, we'll buy a few $1 billion of those bonds you've got. Then they hit a few keys on a computer and poof, new money created out of thin air appears in the bank's account. That's it. That's how trillions of dollars were born. The second leg of the plan was maybe even more world-changing, the zero interest rate policy, or ZIRP. For basically the first time in history, the Fed cut its main interest rate all the way down to zero. The goal was to make money so cheap to borrow that businesses and people would have every incentive to take out loans, buy stuff, and get the economy moving again. Okay, so this 1-2 punch of QE and ZIRP, trillions in new cash and 0% interest. This is what Thomas Hoenig thought was an absolute recipe for disaster. And he wasn't worried about the stuff you might think, like runaway inflation right away. No, his fears were a lot more subtle, and as it turned out, a lot more accurate. Let's just break down why zero interest rates are such a game changer. In a normal world, let's say with 4% interest, saving money is rewarded. A hedge fund or a pension plan can buy a safe government bond and make a decent, safe return. But in a 0% world, that safe return is gone. It just vanishes. So to make any money at all, investors are forced to go searching for yield, which means they have to take on way, way more risk. Hoenig had a term for this, the allocative effect. What he meant was that the Fed wasn't just a neutral referee anymore, managing the economy. By making money free for Wall Street and forcing everyone into risky behavior, it was now actively distorting the free market. It was picking winners and losers on a scale we'd never seen before. So, who were the winners? Well, in Honing's view, the answer was crystal clear. He was convinced these policies were practically designed to widen the gap between the very rich and everybody else. And here's the first major consequence. All that new money had to go somewhere, right? It poured into the stock market, into real estate, driving prices through the roof. This was amazing for the small group of people who already owned those assets. But for regular folks trying to just save money in a bank account, they were being punished, earning basically nothing. The second consequence flows right from that search for yield we were talking about. With no profit and safe bets, Wall Street was pushed further and further out on the risk curve. To make money, they had to start lending to riskier companies and financing more speculative deals, which of course builds instability right back into the system. And the final consequence, and maybe the most predictable one, was that this tidal wave of cheap money and forced risk-taking started inflating new, dangerous financial bubbles. Honing warned that the Fed, in trying so hard to solve the last crisis, was basically planting the seeds for the next one. In the end, Honiak lost every single vote. The era of easy money wasn't just a temporary patch. It became the new foundation of our economy for over a decade, and the consequences have been profound and are still with us today. I mean, just look at the legacy. The Fed's balance sheet went from under $1 trillion to over $8 trillion. Our entire economy got hooked on the drug of low interest rates. That search for yield became the main game in town. And that clear line between a free market and a government-backed one, it got blurred, maybe forever. This wasn't a rescue, it was a total transformation. Which leaves us with the book's huge, lingering question. Look, there's no doubt the Fed's actions saved us from a total collapse back in '08. They probably did prevent another Great Depression. But the question is, in doing so, did they fundamentally break the American economy? Did they create a new system that's more unequal, riskier, and now permanently dependent on the very people who created the problem? That's the unsettling question at the very heart of The Lords of Easy Money. If you have a book in mind that should be added to our list, comment below. If this blueprint helped you, subscribe, like, and build with us. More blueprints are coming. Stay intentional, stay consistent. We are doing this one book at a time. And remember, you are the average of the 5 people you spend the most time with. So share this with them and grow together. Real progress becomes stronger when it is shared. Build your life one blueprint at a time. You do not attract what you want, you attract what you do.